Well, I mean, one of the things in common between Alibaba and Tencent is that last year, Alibaba got 44% of its pre-tax profits from fair value revaluations of private investments and investment gains from floating companies in IPO. And whether that road to riches of investing in private companies in China and then floating them in the US or in Hong Kong is now closed is going to have a major impact on how you really think about the valuations. And the perception of a stock like Alibaba is that it's been cheap. But the reality has been that up to 40% of its earnings were coming from below the line gains. In the case of Tencent, it was 36%. And investors will need to reset how they value these companies when the ability to transform their literally thousands of private investments in China into equity stakes in listed companies in the US may now be closed.
Is it your expectation that we're just going to see much fewer of these international listings from Chinese companies, whether it's in the US, where the US themselves are tightening some of the requirements for overseas listings, but then also in Hong Kong?
I mean, clearly the Didi listing was a watershed where the Chinese government apparently did not want this company to go public, and the company went public in any event. And I think this kind of explains why, even though Alibaba's stock has gone from over 300 last October to 200 now, 93% of the analysts covering it still have a buy rating on it and have maintained their buy ratings because they don't want to give up the tremendous gravy train that Chinese IPOs have provided even in the first half of this year. And the other question that's still out there is whether Hong Kong will be considered in the same light as the US. And what the Chinese government really wants is for companies to be listing in Shanghai.